The price-earnings ratio, or PER for short, is the best known and most widely used ratio on the stock market. The PE ratio is a useful way of assessing a company's value. It's the result of dividing share price by earnings per share. In other words, the PE is the ratio between a company's share price and its after-tax earnings. The advantage of the PE ratio is that it enables an investor to compare different companies using a single calculation. Example: an Apple share is worth $200 and generates a net profit of $10. The PE ratio expresses the number of years of earnings an investor is prepared to pay for a share. Note that a stock with a price tag of several $100s may be less expensive than one with a price tag of a few dollars. To interpret a PE correctly, you need to compare two companies of similar size and operating in the same sector. For example, a PE of 15 for a house building company doesn't mean much unless the investor discovers that the average PE for the house building sector is 35. Thus, comparing the PEs of Peugeot and Renault is very useful. But to say that TotalEnergies is cheaper than LVMH is meaningless. Example: a listed company with a market capitalization of $1 billion, 10 million shares outstanding. Mathematically, this gives us a price of $100 for each share. Analysts forecast a net profit of $40 million this year. Mathematically, this gives us a net profit of $4 per share. These figures allow us to calculate this company's PE using two methods. First method: share price by earnings per share. Second method: also obtained by dividing market capitalization by net income for the current year. The company is therefore worth 25 times its estimated profit for this year, reflecting the earnings growth expected by the stock market. Potential reason for a low PE: company decline, substantial debt, regulatory and legal risk. A low PE ratio can occur when the share price falls while earnings remain broadly unchanged. Potential reasons for a high PE: share price rose faster than earnings due to expectations, massive and regular share buyback programs, the presence of a large moat. A very high PE ratio does not necessarily mean that expectations have become unattainable. Take the classic example of Amazon, whose PE rose from over 70 at the start of 2011 to 130 in the middle of that year. Despite this, the share price rose by 46% over the same period and continued to rise over the next 5 years. If a company can live up to the expectations that a high PE ratio suggests, then the strategy can pay off. The limits of the PE ratio. It is difficult to interpret the PE ratio if the company was losing money in the previous year, e.g. the recovery from COVID. The main drawback of the PE ratio is that it can be biased by exceptional events affecting net income. In other words, non-recurrent events can distort the PE ratio reading. This could be an exceptional charge due to a lawsuit or fine. This is why valuation multiples must necessarily be related to their historical levels. Imagine that the PE of Apple shares is 30 today and that the average PE over the last 10 years is 50. You could say that you're getting a good deal if you buy at a lower price than the historical average. Another limitation is that the PE ratio does not take debt into account. Yet, debt levels are a major factor in valuing a company. What's more, it's not uncommon for a very high level of debt to jeopardize the life of a company. Always check that a low PE is not accompanied by a high level of debt. If two companies have the same PE, but one has a mountain of cash, the choice is clear. For the same price, you get an equivalent production tool with cash as a bonus. Generally speaking, valuation ratios can be affected by external events such as market sentiment and the company's image in the eyes of the public. To sum up, the role of the PE ratio is to anticipate the future growth of a company's earnings. Mega companies with good earnings visibility and monopolistic positions have high PE ratios. It's worth noting that disappointing quarterly results often have a severe impact on the price of expensive shares. Buying shares means buying a share in a company's future profits. Buying a stock at a reasonable price allows investors to optimize their chances of making a profit, while limiting their risk-taking, especially when visibility deteriorates. The PE ratio can be calculated on an annual basis, classic PE, on quarterly data, PE trailing, or on forecast data, PE forward. Disclaimer: this content is for information purposes only. It does not constitute financial, investment, legal, tax or other advice, and the content creator cannot be held liable for any decision taken or not taken on this basis. Investing involves risk. Do your own research.